Fantastic. So let's do the thing I am good at. let's ignore the fact that let's not do the things I'm not good at. Access to this webinar is for educational and informational purposes only. Consult a licensed broker, registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacity as licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionstrading.com. to read the characteristics lists of standardized options. PSW provides education and training services meant to teach the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and the results discussed in this webinar are not typical and only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless. Many losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list to receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone. All right. Well, isn't that fun? All right. How is everybody doing today? Are we getting through the downturn all right? How was downturn today? The Dow popped 100 points, so that's good. So let's see where we are on the charts. Hang on, we'll see if there's anything to trade. I was liking this short. It's kind of scary though, but I was liking the short of the NQs below the 7,500 line, which is right here. We'll take a look at the news before we do that. I don't want to jump into it for no reason, but I just think the 7,500 line is good resistance. So it's kind of intriguing to hit this over here. And we're getting right there. I don't know. See, we already had a good day. We did the RBs, the gasoline. We talked about that last week. They ended up making 3,500 bucks on 2 contracts. This one is still on from last week. The coffee trade, KCZ19, is creeping up. But, you know, it's only 1 contract, and we're up $450 already. So that's not bad. It's just creeping along from last week. You know, in fact, here's last week. We came in over here, and now we're up here. So it's only a penny. It's not bad. You know, hopefully it'll go up 10 pennies and we'll have thousands of dollars. So, you know, this is not a contract I'm looking to get out of at any point. In fact, it was a penny higher. I mean, I'm not looking to jump out of it, but we will see what happens on that one. But, you know, the futures are fun. If you play it right, if you wait and wait and wait and wait patiently for when it's really low in the channel, and then you make a sensible entry, and you keep a tight stop below it, you have you have little chance of it breaking down. Like here it broke down here, right? It went down below where we came in, but it doesn't go down that much because this is good support. But then it pumps up, and if you catch an up move, you're in great shape. So if the up moves are much bigger than the down moves, it's kind of worth playing. And that's the same over here. Like let's go ahead and do this one. I'll catch it. Almost caught it right there. I waited too long. That's because I'm narrating instead of clicking. But anyway, all right. If we're going to play that, let's keep an eye on the, forget the Dow, because the Dow's all screwed up because of Boeing and everything. But let's take a look at the S&P and see how they're looking. And the S&P stopped under 2,800. What is that? 2,860. So the S&P is over there. Oh, here you go, 99 here. Oh, right on. I can't complain about that. I'm catching it right on the line. So 7499.75, and what we're saying is we expect now, of course it pops right over now, so I'm screwed, but we expect it to be rejected, and we'll see what happens. It's going totally the wrong way. At least I waited. At least I didn't jump in and just, that's why you never chase, because it's always you always get your fill eventually. Let's see what the other charts are looking like. So the Dow 25.6, 2850 over here, 7,500 over here, and under 1550 here. And remember, these are, you know, let's get back to today's post. La 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 la. There we go. Okay, so 25,450 is a weak bounce line on the Dow. We're past that now, but I hate to flip back and forth. But 25,450, and we're at 650, and 750 is the strong. 700 is a strong bounce line. 860 is the 5% down line on the S&P. So we got rejected at the 5% down line. That's not really good. That's kind of what made me want to jump on the NASDAQ short. I mean, that's not good when you get rejected at the 5%, minus 5% line, 5% down from the top. And we got rejected there. That's not even a weak bounce. That's reject. You're in the range of the 5% to 10% line, right? So you're like for another 5% down here, let's say. So you're in that range of going down another 5%, and you're stuck in that range and hitting the top of the range like a ceiling. That's not a strength indicator, guys. NASDAQ 74.75 and Russell 1550. So you got the same problem. Well, no, actually 74.75. We broke over here. We're just over that. So a little bit of strength from NASDAQ, but 1550 got rejected on the Russell. So the Russell and the S&P are rejected at their minus 5% line. The NASDAQ is just barely over it, and we'll see if it lasts. It's 1505, it's 7505 already, so it's not looking good for me. But I'm not going to worry about it unless these guys come over also. So if they go over their lines, if he goes over 1550 and he goes over 2860, then I'm going to get the hell out of this trade with a loss. But unless they do, I think that the NASDAQ is just being silly. And of course, you know, with Apple's doing well, the NASDAQ's going to do well, so on and so forth. Oil's up to 62, Brent is up to 72, gasoline popped to 202, and we got out of that trade over here. Natural gas is 261. This one is going to be playable again if we can get back a little bit low. Just about, I'd like to catch that line. Obviously, I should have caught that line earlier, but whatever. We were doing something else. So I wasn't looking. Gold's good. Silver's good. Look at silver. Every time it comes down to 1460, it's a buy. And that's the thing. You've got to monitor those levels and know where you want to make your entrances and exits for that matter. You can't just blindly go into these things. Rich says, can talk about why you chose the 280 puts for BA. Why not 250 or 300? Do you look at Delta recent lows or simply the premium available? Thanks. And Brendan asks, what are your thoughts on MT? All right, well, one at a time then. All right, Rich, BA. Okay, that's a good question. So in chat, we just BA. It's probably a lot of BAs. 33. Wow. It goes by the string, it doesn't go by the, it's not looking for the stock BA. There it is. So it sounded like the FAA is looking to approve BA and coordinate with all the other countries to get them back up, the 737s back up and running next week. Now, 2 minutes later, people started screaming that the FAA isn't reliable and you shouldn't trust them and they're in BA's pocket and they're being bribed and blah, 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 blah. But whatever, at least we're making progress. That's what we'll call progress. And look, at this point, it's not realistic to expect that they've ramrodded a plane with a problem through. I mean, BA, you know, if you can say BA did something wrong in the past, and I believe they did, I think that they look, they put a software patch, and we had some engineers who stuck up for them, but they put a software fix on a hardware problem. They built the plane in such a manner that it tended to nose down. No, I'm sorry, it tended to nose up. I'm not. Because they moved the engines forward to save fuel, when the plane thrusted, it tended to nose up. To compensate for this design flaw, and it is a design flaw, and to continue to save fuel, they could have changed the wings, they could have moved the engine, they could have done a lot of things, but then their selling point of 15% better fuel efficiency would have been lost, and they wouldn't have had any advantage over Airbus. So rather than risk losing some money, which is what they were basically doing, rather than risk losing a bit of money, what they decided to do was put a software fix on the problem so that the plane software would compensate for any move up if the plane tilted up, it would compensate by pushing the nose down 2%, which, doing the things that the autopilot did, what the pilot would do to nose the plane down 2% to compensate. And it would do that until it felt the plane was at the right, heading, the right level. The problem is, though, it was all based on one single sensor, and that sensor, if it failed, then caused a feedback loop in the software that kept nosing the plane down 2% over and over and over again until it crashed. And it would fight the pilots all the way down. The pilot, even if they followed the instructions and disengaged the autopilot, after 30 seconds, the autopilot will reset itself unless you give it some other command codes that a lot of people were not aware of, because they don't generally disconnect the autopilot in an emergency. So you couldn't just disconnect the autopilot. You had to disconnect the autopilot and tell it not to come back on. And that's what killed both of those crews, basically, was the fact that the autopilot came back on and started, despite they thought they turned it off, and it came back on and then continued to try to kill them. This is not good. and Boeing knew it was a problem. They've had fights with pilots over it being a problem. They just didn't want to hear. They're like, la, 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 we like to sell our plane the way it is, and it's not a valid complaint. Until 2 planes in a row crashed, and they had to admit, this is bad. We have to do something about this. Now, the liability for killing 300, 400 people in an airplane isn't, unless you can prove gross negligence, which they probably aren't going to be able to do. They're just going to be, it's basic negligence. It's not going to be like this insanity with Bayer, where they're getting fined $2 billion for every person who gets cancer. Boeing will pay $5 million, $10 million to 400 people, which is a lot of money, which is $4 billion, let's say. So Boeing will pay a good amount of money to settle these cases and to make it all go away. But it's not a big amount of money in the grand scheme of things for Boeing. So there's a reasonable, like BP and like other disasters, it's a disaster they now have fixed, and they will move on as a company. They will not redesign this plane, though. They still are selling this plane with the software fix. What they've done is they've improved the software fix, made some redundancy in the sensors, so on and so forth, to fix the situation. Anyway, so that being the case, I've just been waiting for the FAA to clear, for them to be cleared to fly again, because Boeing is an amazing, powerful company with huge sales and all that. And let's in fact look at the numbers. They're somewhere. Here they are. BA. Boeing. And the thing is, it's kind of like Facebook. It's like, where else are you going to go? You can bitch and complain about the company all you want, but the bottom line is there's only 2 plane manufacturers really in the world, and they're one of them. I mean, yeah, people say, oh, China this and Brazil. Brazil has Embraer, and China has a thing, and Russia's got a thing. Nobody's buying those things, and not for decades. Will that? They could be better than Boeing, and they could be better than Airbus, but people aren't going to really buy them, not for the next 10 years or so. So it's not really something you should be worried about as far as an investment. So meanwhile, Boeing, $10 billion a year, dropping to the bottom line, this year less, $12 billion, and then this is partly because of the shutdown, what happened. $12 billion next year, 12, 15, 20, blah, blah, blah. So $4 billion over X amount of time. That's partly going to be insured by their liability coverage, blah, and everything. Forget it. It's not even a thing. So the bottom line is, for $10 billion a year in profits, you are paying $200 billion, which is only 20 times the profits, and the profits are expanding. So it's a good deal. All right, so Boeing's a very fair deal at $345, even after they get sued, even after everything else. Now, so what did we do? So we said, since things are finally clearing up for Boeing, we said, well, let's go ahead and raise some cash. We like to raise cash in a long-term portfolio by selling puts, and we have nothing else to. We have tons of money sitting on the side. We have nothing else to do with it. So and that means tons of margin. So there's no reason not to sell it. So the question was, getting back to the question, was Rich asked, why did we choose the 280 puts? Why not the 250 or the 300 puts? Okay, step number one. What am I comfortable with? I'm comfortable because 280 is $60 less than 345. It's practically 20% lower. not even taking into account the fact that our net entry is 260, which is $85 lower than 344, and 85 divided by 344 is 85 divided by 344 is 25% below the current price. So our worst case scenario is we have to buy Boeing for the net of 260, looking at that. Now, he's saying, how do I select that? Why didn't I pick the 250s? Because the 250s get me in at 240, which is only $10 less, and I get an extra 10 bucks by selling these. So why would I sell these for well, let's say 11? Why would I sell these for 11 when I could sell these guys for 21? It doesn't make sense. It's like, yeah, I'd be netting in for a lower price, but it's not enough to make it worth it. And that's what it is. I pick a price I feel comfortable with, which is, so I start off at 20% below the current price, and I am, yes, looking at I am, of course, looking at the long-term price action for Boeing, and I'm doing the math that we just did on the sales and all that, and saying, well, where are they going to be? What's going to really happen to them? Nothing really, nothing in the grand scheme of things. So I'm comfortable that 260 is a really good floor. So we sold 280 puts. I don't think we're going to go lower than we went in December. Okay, so I think this is a realistic spot for Boeing. Now, back in 2017, they were averaging 175, 180. That's quite a bit lower. Okay, so what was their story back in 2017, though? They were coming off a year where they made $5 million. $5 billion. They're coming off $5 billion because this was the end of their cycle. The beginning of the new cycle for the new planes started right here, and sales popped up 10%. They're going to pop up another 10% as fast as they can deliver these things. They've got back orders for, they've got $1 trillion worth of back orders basically of these planes. So they'll be selling $100 billion worth of plane year after year after year for the next decade. They're just going to make as much money as they can, as fast as they can, and then they'll have another down cycle when they're done with these planes. That's how this business works. They sell, at one time they sold 707s, and they sold 727s, and they sold 747s. Now they sell 767s and 787s or whatever the hell that thing is. So, that's their cycles that they keep going through with Boeing. So they're going to keep going through those cycles. But we're now at the beginning of their next big ramp up in profit. So it's not like it's going to backslide. Okay, this was all developed. These are development days when they were cycling down their old planes and moving into cycle up to the new planes. And there was a lot of R&D spending in here, and there will be again. They'll start spending R&D again down the road. But again, not our problem. What we want to do is when it comes to $12–15 billion of profit, and the thing is, and they're trading at 300 bucks, we're going to be long gone from this stock. All we care about is they don't go lower in the next 24 months. So that's what we sold. So that's the targeting thing. And of course, don't forget that if we got assigned Boeing at 260 net dollars, we would turn around and sell, well, if it was assigned, but if you sold the 340 calls now, look at the price of these things. They're 50 bucks. All right, so let's say we get assigned at 260, and then we turn around and sell the 260 calls for 40 bucks. Now we're at 220. Let's say we then sell some 220 puts for 20 bucks. Now we're net 200. That's if we take possession of the stock. We don't have to take possession of the stock, or if we do take possession of the stock, we can immediately flip it out and move it to a call for half the price. So our exposure is much less than you think. Plus, of course, we can roll it, because if we were assigned today, the what are they, 344? So if we were assigned today, the let's pick something in the money, the 380 calls, right? So let's say it was expiring today and it was at it's a 340, and we have the 380 puts and they're 35 bucks. What would we do? Well, obviously we'd roll them to something else that's 35 bucks, like the 320s. All right, so these are the current, I lost track now. The 380s. So we would roll the 380s to the 320s. So we'd roll them down 60 bucks, which is 20% almost of the stock price. over 2 years. If we can roll down 20% of the stock price every 2 years, that means in 10 years we would be rolling down to the $0 puts. So it's not so much that we're worried about assignment. And again, obviously, if Boeing goes bankrupt, that's a big problem. If Boeing loses half their value, that's a big problem. But we super don't think that's going to happen. It's super duper unlikely that's going to happen. So, so realistically, we don't think there's a big risk there, because we would roll the 280s down to the 220s, and then we would roll the 220s down to the 140s. And then we'd roll the 160s, and then we'd roll the 160s to the 100s. So, unless we think over the next 6 to 8 years, Boeing's going to be below 100, this isn't that risky of a trade. So all those factors come into play. It's like, where can I roll it to? How deep in the money is it? How much premium does it have? How likely is it that Boeing's going to fall 20%? 20% would be a radical fall for Boeing. Now, it could happen if the whole market wipes out 20%, and Boeing can go down 20%, because recession fears make you start thinking that the airlines are going to cancel orders. It's not completely without risk, but the worst case scenario, like I said, is we end up owning Boeing, selling calls, selling puts, knocking another 60 to 80 bucks off the stock price. We're already going to be in there at 260, so we'll be down below 200. 200 is like almost half the price it is now. So the bottom line is, as an individual person, that's my play in the long-term portfolio. I don't mind that amount of risk. If you think Boeing can drop that hard, don't make the play, because whenever you sell a put, your downside is being assigned the stock at that price. You don't want to do that unless you really feel strongly that this is going to be something you can deal with down the road. All right, and the long-term portfolio has $1.5 million of positions. It has $3 million of buying power. Our worst case is being assigned $200,000 worth of Boeing, or $260,000 worth of Boeing, which we would then turn into $200,000 worth of Boeing. It would be a big percentage of the portfolio. But again, I like Boeing being a big percentage of my portfolio. I like a blue chip airline company with no competition to be a big percentage of my portfolio. So when I see Boeing down, I've been licking my chops to sell some puts ever since they started falling, but I wanted to wait and see where, how bad was the situation, so on and so forth. When I hear, even though there's going to be fights over it, when I hear the FAA now saying, okay, you know what, they fixed it, I think it's fine. Even though people don't trust the FAA, even though they think the FAA is in Boeing's pocket, even though other countries are going to be a lot stricter about testing it, might give them a 3-month, 6-month delay, it doesn't matter. The point is it's fixed. I don't not believe Boeing. Boeing is not Elon Musk. I don't think, they're not lying. When they say they fixed a problem, given their 100-year history of making airplanes, when they say they fixed a problem, they fixed a problem. They do take that seriously. They may have ignored the problem in the beginning, but they have now fixed the problem. They've now said, oh my God, people died. We are going to fix this problem. There's plenty of serious people at Boeing who do care very much about customer safety. It's not necessarily people in the accounting department, but people, or even at the CEO level, but there are engineers sitting there who could care less about what something costs and care about safety. They fight with the accounting department about fixing things and doing stuff. But also realistically, you have to understand airlines is a business, and then Trump owned an airline, actually. So he bankrupted it, but he owned an airline. Airlines as a business are always trading off money for safety. You're not flying in the safest plane money can buy, because the safest plane money can buy would be too expensive. An airline should have a paramedic on board in case anybody gets sick. They don't do that. That's expensive. All right. Your seat should be made out of much sturdier material. There should be crash cushions in front of you. There should be airbags all over the place on a plane, just in case you hit the ground and you have an accident like that. There should be fire suppressant systems all over a plane. They're not there. Why? Too expensive. Planes don't blow up often enough to do that, so it's not worth it. There's always a trade-off. That goes for cars too. There's trade-off in cars, there's trade-off in planes. A lot of your life is always being calculated. Now, the weirdest thing that's going on now is, of course, self-driving cars. Self-driving cars are all about the trade-off. There's no such thing as 100% safety. You are going to crash. People will crash. Accidents will happen. People will die. Okay, and it won't be necessarily for lack of a safe car. Just there's too many variables on the road for everybody to be completely safe. We will be much, much safer when we're in self-driving cars, but there's still going to be a number that's going to be what they call acceptable losses. Okay, first of all, you have an acceptable loss because you have to vote, and you vote to say, damn it, I want to drive 65 miles an hour on a highway. And the Highway Safety Commission says, well, if you drive 65 instead of 55, an extra 10 people will die next year in your state. And you're like, okay. And then when somebody dies, you go, oh my God, what a tragedy, blah, blah, blah. But meanwhile, you're not going to start driving 55 miles an hour just because somebody died. It's human nature, and it's also economics. You're making life and death decisions all the time that have odd consequences that you can't always predict what's going to happen next. So it's just when a company makes them, like Boeing, everybody freaks out. But the reality is, and the courts are a bit more aware of this reality, you can't ensure everybody's safety 100%. You simply can't. It's not, and ultimately, then, if there's a business decision, in other words, if there's a business decision that they didn't make the hull of the plane out of titanium, just as an example, because it was too expensive, but it would have been safer, and that's okay, then the business decision that they made this software fix that wasn't 100% effective instead of something that would have been 100% effective. It's maybe not as okay, but it's not 100% not okay. Somewhere in between, and this is what courts are for in theory. Of course, courts are getting kind of weird, but in theory, the impartial courts are supposed to be able to decide these things and say, well, you know what? On the balance, this is how it works. This is you may not like it, but this is how life is, and that's why Boeing is only going to pay no more than about $4 billion in fines. And we'll be fine, basically, moving forward. So there's my investing premise on Boeing. All right. Brandon says, what are your thoughts on MT? Now, MT is a whole different deal because we specifically have steel tariffs that are messing them up. But they are muddling through and doing their thing. So I'm happy with MT as a long-term bet, not a short-term bet, but eventually things will get better. They're a fantastic producer of steel, a really solid company, and I like to pick them up when they are cheap. So I haven't actually even paid attention to how they are lately. So let's see what they're doing. No, they've been trending down apparently. So they're still going down. I forgot what our position is in MT. I'm sure they're in a long-term portfolio. Oh, there's a long-term portfolio. Wow, what a hit, 158%. I think we were like at 178%. So we were 145 and we were 13 basically. So we're down $150,000, but down about 10% in the portfolio. MT. Oh no, we don't even have it there. Where the hell do we have MT? Oh, I'm stumped. Oh, there it is. Okay, we just have this little 23-30 spread. Okay, and here's 17. We're gonna have to, well, if we're gonna stick with them, we're gonna have to obviously fix this. But what we're gonna do is buy this back, roll these down, and see if they bounce. But now the question is, do we believe in them still? Because that's nasty. That's much worse than I thought it was. So, oh my God, wow! No wonder I didn't know this happened. Look at that shit. Holy crap. All right, well, okay, so let's see I can't give a flip answer on this because I don't know why we went from 24 to 17. That's freaking awful. I was not paying attention. That's catching me by surprise. Apparently, there's a serious decline in profit, but look, they're erratic. It's a steel company. Look at the loss. They're not losing 10 billion, but they're not making 4 billion either. This is with the tariffs and everything else going wrong at the moment. They've dropped their estimates a lot. Their market cap is only $17 billion. If they can make $3 billion on $17 billion in market cap, that's a PE of 5. And the problem is they're cyclical, but I think we're coming into an up cycle, not a down cycle. The only thing that's killing them right now is the tariff bullshit, I think. But let us see, because that's news to me. I did not know Mattel had such a huge fall. So shame on me for not paying attention when they drop like that. I did not see that happening. Earnings missed sales top estimates. Mattel lower profits in the first quarter. The company generated $400 million. Not that good. So 400 million, if you just quickly multiply by 4, you're talking about $1.6 billion pace. That's terrible. All right, that's all of a sudden not as good as we thought. So sales were up a bit. Barring one time, they came in at 53 cents. That's still not going to get them anywhere close. Total steel shipments rose. I mean, this is with tariffs, so they're doing pretty good. To 23 million. The upside can be attributed to high steel shipments in Europe, offset by lowest shipments to us. Average selling prices fell 3.1%. Wow. Segment review. NAFTA. Crude steel production fell around 8%. Production down. Europe crude steel rose. Brazil rose. Africa, wow, 20% drop in Africa. That's nasty. Iron ore production was down a little bit, no big deal. They have cash. Their cash is down $2 billion. Their long-term debt's around $10 billion, and that's up. So they're burning a lot of cash. Outlook. In the United States, growth, blah, blah, blah. They're unchanged. This is expected, driven by persistent growth of non-residential. I mean, I think we're coming into a cycle for this stuff that's going to be good. ESC is expected to rise. The company overall demand flat. The company expects to witness higher steel shipments. Wow. Key takeaways. I got to find out what's going on here. This is nasty. I don't see it though. I don't see if they've lowered their guidance. What have they done? Revenues are similar to first quarter 2018. The company posted, okay, so they're similar to 2018. They adjusted EBITDA in the fourth compared to 1.9 in the fourth. 2.5 billion in the first quarter of 2018. It was the lowest since 2016. So what does that mean? They adjusted their earnings down? No. Operating income last year. So Q1 last year is 1.5 billion. Can't get away from that. We're half of last year. Last year they came out 1.5, 2.3 is 3.8, 4.8, 5.3, 6.3. So they made about $6 billion last year. If they go half, they're still going to get that 3 billion number though. Even if they stay down here, even if this persists, there's still $3 billion, which is still not bad for a $17 billion company. No, it's a cyclical. I'm inclined to stick with them. I mean, ugly as this may be, I still don't see why I'd want to dump them just because of this. Anyway, so what do you do if you're going to stick with a cyclical? Well, in this particular case, since we don't have any short puts, what we would do is we would buy back the short calls here. We would roll these 23 calls down to something lower. So let's see. MT. And how many do we have? Do we have a lot? We only have 20, so it's not even a big position. You know, we're down. We're only down 3,600, you know, 3,600 bucks or 3,500 bucks on the whole thing. So basically, we're going to essentially take a new position, but we're going to go to the 20. So we're going to actually, that is what we're going to do. We're going to take the $3,500 loss. It doesn't matter if you call it rolling down. We're going to sell these things. We're going to buy. Where are they? It's 17. You want to buy something with not too much premium. So these come out at 1880, and they're at 17. These come out at 17. Wow, 1750. These might be more attractive. Depends what we're going to sell. But if we went for the 10-18 spread, that's, let's say, 750 or 760 plus $3. I mean, minus $3 is 460, but it's 460 on an $8 spread. I don't know if I'm in love with that. Or we go with the 13s for 585 and sell the 20s for 2 something. So that's 260 minus 220. I mean, 560 minus 220 is 340 versus, what do we say here? It's going to be 4 something. 1320 or the 1318. I might like the 1318s. Anyway, so we do these things instead. Then we're going to sell probably the 18 puts, because I certainly think this is a reasonable price for 350. That would knock the net down to like nothing. And if we do 20 of them, it's going to be a $16,000 spread for net maybe $2,000, $3,000. So the upside would be $13,000 less the $3,500 we lost, and we still have $9,000 of upside if they just hold the price they're at now. So that's how, so that's how we'll make an adjustment. Again, I've got to read more and figure out if I want to stick with this trade or just take a $3,500 loss and go. But I'm inclined to take advantage of the drop and stick with the trade. In fact, frankly, I don't think I'd want to even do a full cover right now. I think they're just way too low. But again, I got to just read some more stuff and see what's going on. Sunny says, what's your take on Macy's now? We just sold puts on Macy's. I definitely like them at this price. It's so silly. And they just announced, not only did they announce a great quarter where they had a nice beat and they are reaffirming guidance and everything else, there's another one that's ridiculously cheap considering how much money they're making. But they're also going to sell, they're going to develop the top. They've got a building in downtown Manhattan. It's their flagship store for America. It's the original Macy's. It takes up an entire block in New York, and a block in New York isn't like a block in like a normal town. A block in New York is gigantic because the block is a block. The block is like a city block. It's basically 1/10 of a mile is one block, or maybe a 20th of a mile. I don't know. It's a lot anyway. It's somewhere in my mind, I think it's a 20th. How big is a city block? Okay, yeah, so it's 16, 17 a mile. So anyway, so it's about a 20th. But see, this is what I'm talking about. That's a block, but then the avenues are gigantic. So, you think of a block, you might think of this in a lot of cities where they're just square, but that's not how New York is. New York has these huge avenues. And an avenue would be a good 2.5 blocks. So you're talking about this massive piece of real estate right in the dead center of Manhattan, not too far from the Empire State Building. And what they're going to do is probably about 5 or 6 stories now. It's a big, sturdy building. So what they're going to do is they're going to build on top of it a skyscraper. And they're selling the air rights, but they're not just selling the air rights, they're developing the building. So they're going to build and sell and lease a gigantic thing. And the cachet for the building, of course, is that Macy's is downstairs. Your building isn't above Macy's. It means that you can get your food there. Macy's has a gigantic food court. They've got a supermarket. They've got all this stuff. They've got all these different things you can do. But it's an attraction because your clients get to go there. They go to Macy's. Believe me, it's a key place. It's going to be huge. It'll rent out for a fortune. So they're now developing this thing that they can do. It's going to be a multi-billion-dollar project that they're going to make a huge amount of money and constant rent. That means they're going to have constant cash flow from this thing forevermore, so on and so forth. So I like that idea. Meanwhile, today, despite the news, well, maybe now it's turned back up, but earlier this morning it actually went down. just because it was following the market down, which was very silly. So we took advantage and sold some puts. So let's see what's happening here. They're still down. I mean, crazy. It went up, and this was what happened on the earnings announcement. Then it went all the way down here. We sold the puts down here. It went back up, and now it's kind of floating along, but it doesn't matter. Eventually, I'm not, I mean, this is a ridiculously low price for them. So we're just going to have to ride it out until it fixes itself, until the value is realized. What is your take on Macy's now? Also, oh no, that's what somebody just asked. Brandon says in the long-term portfolio, it looks like you're short 15 puts and long 40, 15 calls. Okay, Brandon, because he was talking about MT. And whoop, shoot, go away. Ah. All right. No, I'm not sure where you're getting that, unless there's more MTs than I think. MT. Nope, that's it. So I'm not sure where you're getting your numbers. Did we already roll them? Maybe we rolled them in the, is that what you're saying? Did we do a roll already on them? Possible. I mean, they're certainly close to where I would want to roll them last time. So in our April review, we did, sorry. Oh, we did exactly what I said, basically. Oh, no. All right, so I said, let's catch out the whole position for 35 and pick up. So we now, wait, 20. No, that's the position we're in now. So we cashed out some other position, and then we moved into this one is new. And I said, we'll see how it goes from here. So that's what happened. We lost 3,500 bucks. Better than losing 35,000 though. What was that position we got out of? Oh, I see. We had a more aggressive position, and coming into earnings, we had a more aggressive position that was up slightly. So we cashed out this position when it was up $14,000 and traded it in. So that was smart. And we traded it in for a position that lost 3,500 on bad earnings. That was very clever, right? So in other words, we were up 14,000. We weren't sure what was going to happen on earnings, so we cashed out the position that was up $14,000. And now we went into a position that was tighter without the short put risk, and that position is now down 3,500. But now we're going to go back to the same kind of position that we made $14,000 on last time it went down like this. Freaking brilliant! Holy cow! All right. Anyway, so that's this position. This position here is the position we moved to after we got rid of the other one. So you're looking at an old long-term portfolio that was before we did that change. All right. Anyway, so we got that in the short-term portfolio. We're not gaining much ground because 610% is nothing. We're not gaining much ground because we're not getting the big sell-off we wanted. We're still up around that 5% mark, which is not where our things trigger. I love the butterfly portfolio, still at 62%, just basically right where we left it a month ago. The money talk portfolio, it took a hit. I think it topped out around 150%, so it's down about 25,000 bucks. Oh no, I'm sorry, not half of 25,000 because it's only a 50,000 starter. So it's down $12,000. It's really not a big deal. It's down 10%. That's going to happen. If the market's down 5%, the kind of options that we do are going to be down 10%. You're going to lose twice as much as the market. And that's the only one we look at, the OOP. So the options opportunity is, wow, that's doing nicely. 166. That's way better than I thought. So that's $266,000. So that's still in pretty good shape. So it'll be interesting. We got a lot of adjustments to make. Shoot. Are you kidding me? Oh, guys, nobody told me. I was thinking that options were next week. We expire on Friday. I got to do all the freaking portfolio reviews now. Oh my God, I had it in my head it was next week. I didn't even do a single portfolio review yet. And I hate doing it in a crash too. It's so hard to like decide what you're gonna get in and out of. Oh my God. Oh, you have no idea how much work this is gonna be. Oh, I want to cry. All right, I'm ending this webinar so I can start working on my portfolios. I have to do these all by freaking Friday. Ah, God. Unbelievable. Wow, I'm so angry. I don't know why I thought I had more time. I guess it's because there's 2 weeks left in the month after this week, and I wasn't thinking that I really just thought it was next Friday. Guys, you got to remind me on an expiration week. If I don't have a portfolio done, if I don't have at least one portfolio done by Tuesday, you've got to ask me what's going on because I messed up. I now have to plow through all these things. That means I have to go over every single position in every single portfolio, all these one by one by one by one. See that right? The time it took me to talk about Mattel, right? That is a minimum of how much time I have to spend on every single one of these positions in every single portfolio we have. I have to look at each one, look at the numbers, look at the chart, look at the recent news, look at what their earnings are. Shoot me now. Oh my God. We should have cashed out, man. My life would have been so much easier. Oh, I'm very sad. All right. Moving on. Let's see. Oh, the NASDAQ. I forgot all about that thing. What happened? Ah! He's still not at 2860, but the NASDAQ is really taking a pop up here, right? And wait. All right, RB's down. That's fine. He's not at 1450. It's only the NASDAQ that's popping. Damn it. All right. I think that might be just a straight out loss. Let's see. Is this the news? Is this today's news? Yeah, it looks like it. So what's going on? Why is the NASDAQ popping? Sony issues upbeat full year forecast. That's helpful for everybody. GE Power to be significantly cash flow negative this year. Yuck. That's why we don't play them anymore. They got too concentrated on that division once they sold off the other thing. Nobody I care about there. Trade Desk, Virtue, BHP, New Jersey Cannabis Consumer Tweets legislation. Ugh, yes, I know about this. Believe me, we were all set to have a license in New Jersey with my marijuana company, and we have to wait now. Very annoying. Southwest orders more buybacks. Beyond Meat, yes, Tim Hortons. Now, Tim Hortons is the same company, QSR. They own Burger King and Tim Hortons. Burger King already has a deal with Beyond Meat, and they're already selling those Whoppers with it in. That's rolling out nationally, and now they're doing the sausage patties for breakfast sandwiches. And actually, given that those sausage patties already taste like cardboard, I don't imagine it's going to hurt the flavor at all. So, yeah, I mean, it's like you want that kind of thing. It's like the sausage is nice and like an Egg McMuffin-y kind of thing, but it's really not very good. It's never good sausage, really. So it's kind of interesting. I think it's probably a winning product. Transocean borrows more money. Southwest Airlines declares a dividend. Credit card delinquency rates are Wait, this is from March. What's from like? Oh, they don't go back far enough. I don't. What are you going to learn from this? I mean, you can see a trend maybe, but it's not real because you don't know what goes on in what month and what happens. Look at Synchrony is doing good. They got lower. Oh, quarterly. See, that's different than charge-offs. I don't know what you could make of this thing. That's a very unusable chart. And it doesn't explain itself at all. There's no text. It's just a chart. All right. UPS cuts 150 jobs. There's nothing here that would have moved the NASDAQ higher, which makes me want to short it more. There's no reason the NASDAQ should be up here. So, I just want to see how the Dow's doing. I'm going to go one more. Rather than just give up, I'm going to go one more at 75.25. Nope, still higher. All right, so now I have two with a $500 loss. Going to have to get out. If it goes to $1,000 loss, I'm certainly going to get out. But hopefully we can get even and get out of this thing. It's just not a working trade. We'll have to see what happens. And how is NG doing? How's natural gas doing? That's one I was interested in getting into. Well, look, our coffee's still making a little bit more money. It's moving along. NGV19. It's October natural gas. All right, let's put one on. Let's see how it goes. We're going to add one here. And next week we'll check in on this. But that's, I mean, it's a long-term trade, the natural gas one. Because NGV19 is the October contracts. That takes us all the way into hurricane season. So if you get a hurricane, you get a nice pop in natural gas. If we had a trade deal with China, we'll get a pop in natural gas. If LNG exports pick up with other countries, we'll get a pop in natural gas. So lots of ways to get a pop in natural gas. Also in the summer, well, April actually, people start right now in April and May, everybody starts opening their pools, and most pools are heated by natural gas, and that causes a drain on natural gas because heating up a pool from scratch takes a fairly tremendous amount of energy. So that's a big drain on natural gas this time of year. And then, of course, once people start turning the air conditionings on, must be about 1/3 of the power in this country comes from natural gas. So that causes another drain on natural gas. So there's many, many ways that this could go well, and hopefully it will. All right, so we'll get back to that later, see if anybody has any questions. Nobody has any questions, so that's going to make my life easy. And what else are we looking at? So let's talk about the hedges. That was a very important point. So this morning, we talked about adding hedges. And we already have hedges. But I want to explain what I was talking about this morning, because that's important. All right. In the short-term portfolio, which is our main hedges, the short-term portfolio, for those of you who don't know, hedges the long-term portfolio. So that's its whole purpose in life, is to hedge the long-term. Oh, look, you gained 3% while we were sitting here. In the last 5 minutes, it gained 3%. See, that's good. That's a good sign. That means that the market might turn down. So the long-term portfolio is basically all bullish positions. The short-term portfolio is all hedges, mostly hedges. The short-term portfolio is there. We'll take advantage of any cool play that we think is going to make money in the short term. It's not limited because we have all this cash sitting around doing nothing. So if something comes up that we think is interesting, we'll do it. Like the short, whatever the hell they were today, the Macy's puts that we sold were for the short term. I think they were for the short term portfolio. And I think Boeing was for the short term portfolio, wasn't it? But whether it was or wasn't, the point is those are the kind of trades we want to put in there. And just to raise some cash, and the raising cash, which as you can see works out great. You know, we've already made $10,000, $14,000, $15,000 here on these trades. potentially can still make another 15,000. So we made half the money so far that we expected to get on these short puts. And it's just once in a while we sell some short puts. What are the short puts for? We offset the hedges, though. That's the thing. So TNA is a nice hedge. We're expecting it to go lower. That's the ultra long on the Russell. The ultra short on the Russell is TZA. We have a very aggressive position here. We have 200 long calls and 40 short puts. These are not a cover at all. These are short puts, so they're further in that thing where we sold the $10 puts. So basically, we put our foot down on the Russell and said, you know what, this is a bit too much for small caps. So going out all the way into January of next year, we're saying we don't think the Russell is going any higher than it has been. But again, it's a hedge. You know, by our worst case scenario, we get stuck with 4,000 TZAs at $10, which is $40,000, and we have a permanent TZA hedge. I don't mind that. That's not a bad worst case for us, so I'm not worried about that. Now, what I said here, this is what you got to follow the logic, though. Okay. Since we already have 200 uncovered TZAs in the short-term portfolio, right there, 200 uncovered. These don't count as covers. These are just another bet that TZA is going higher. This is just naked long calls. But since we have 200 naked long calls in the short-term portfolio, we can be more clever than that. And I mean, so now I gotta go back to that. But we can add 100 July 8 calls. So in other words, as a new bearish hedge, as a new hedge, we add 100, well, same direction as this, July 8 calls. And I said we could because we haven't actually broken down lower yet, so we're not rushing into this thing. But this is what we can do. So the 100 TZA July 8 calls, they cost 17,500. Okay, but we can offset the cost of that by selling 50 of the 13 calls for 210. So if we sell 50 of the 13 calls, these are the sevens, we're not at 13. So if we sell the 2021 13 calls for whatever it was, for 210, we're going to raise $10,500 out of the $17,500 we spend on the new spread. So that knocks the cost of the new spread down to that. The cover can't possibly hurt us because we already have 200 of these. We're 4 times covered on the short 13s. So all it would do is limit the gain of 50 of these calls to $6, and not the gain, but to limit the spread to 13 to $6 total. And $6 times 50 is $30,000. So we're eliminating 1/4 segment of this to pay back $50,000. Sorry, 6 times 50, 30. I'm sorry, 30,000. To pay back $30,000. We're eliminating 1/4 of it to pay back $30,000. There's no limit on the other 150. So there's no way that sale can hurt us. That's what you have to look to do. You want to take advantage of things you already have to raise capital or to get or to generate income. It's the same thing I was talking about, saying like, oh, if we get assigned Boeing, then I'm going to immediately turn around and collect 60. So if we get assigned Boeing at $260,000 net, I'm going to immediately turn around and sell $60,000 to $80,000 worth of puts and calls against it. And that will drop my net down below $200,000. So when I think about being assigned something, I'm also thinking about, well, now that I'm assigned this asset, what can I do with that asset to generate capital? And it's the same thing when you're looking at your portfolio. You have to say to yourself, well, I got this portfolio, I've got these positions sitting here. What could I do to generate an income off these positions? Now, we already know from prior calculations that we've done, and we've done the webinar, so you guys should know this, but we already know that our target on TZA is about 14.50. We really don't think it's going to go lower than 14.50. We don't think the Russell's going to go lower than 20% below where it is now, which means that basically back to where it was in December. We think December was an overkill So we don't think the Russell's going below 1266. That's a 20% drop. So therefore, if that's as low as the Russell's going to go, then we don't think that that TZA is going to go up more than 50%. 50% plus 967 is obviously 450 plus 967. So you're about 14 bucks, just a bit over $14. So that's it. Very simple logic, right? So therefore, we're really not going to be hurt at all by selling 13 puts. And if I can get paid $10,500 for selling 13 puts that can't possibly hurt me, what reason would I have for not selling them? So the situation comes up. I want to sell something. I want to sell something in the Russell to offset my bearish bet in the Russell. There's nothing better to sell as an offset than another Russell position. So I don't want to cap my gains of the short-term TZAs. The July TZAs we're buying, if we get a pop in the Russell, I want to sell them and take the money off the table quickly. Whereas these long-term ones, I can let those ride for quite a long time. So that's the logic, and it's difficult to get used to thinking the next move and the next move and the next move ahead. But it's just like when you play chess. It's like the more you do it, the better you get at thinking ahead, and the more you think ahead, the more prepared you are for whatever happens to come along. Well, the U.S. and Canada are discussing metal tariffs right now. Isn't that nice? Not going to help them tell because they're in Europe, but at least we are talking to people about things. So that's encouraging. Boy, I do love this marijuana ETF. That's a sleeping giant too. There is one problem with the marijuana industry. It's that all these companies that are public, they mostly suck. They got a lot of money, but they're not making any money, and it's unbelievable. It's like, how can you lose money in this business? It's selling marijuana is like it's like being a farmer and selling an ear of corn for 50 bucks. It's like, how can you not make money in this business? It doesn't cost the same ear of corn. It costs you 10 cents to grow it, and you're selling it for 50 bucks. That's what marijuana is. It's just insane. The markup on this product is unfreaking believable. And the insane regulations we have in this country are going to keep it that way for quite a long time. Realistically, if marijuana was legal everywhere and there wasn't such a stigma about it, you could just have a little indoor growing thing, like a little thing with a heat lamp and a grower and whatever, and you should be able to grow yourself some very reasonable marijuana that would cost, it really would literally cost you nothing. I mean, it costs you the price of the setup, maybe, let's say you buy a $1,000 deluxe thing with the waters itself and does stuff and whatever, and keeps the humidity and does all this stuff, right? Once you plant the freaking thing, it's just gonna grow. And you're going to be able to whenever you want, you'll be able to harvest the leaves and take them and smoke them and do whatever you want with them. And that would be it. You'd have a one-time expense, and then for the rest of your life, you'll have pot. So it makes its own seeds. And it grows, it makes its own seeds, so you get new plants anyway. And you can buy, really good seeds from lots of places. That's one of the things we're working on. In fact, we're patenting strains of seeds now because we expect to be able to sell them down the road to consumers. But so the problem is that the companies that have gone public are generally pursuing the same strategy, which is, just they're opening up stores everywhere. They're opening up growing places everywhere. They're just spending so much money that they're losing money. They're losing money on a business with a 10,000% markup. It's insane. And to some extent, people are like, well, maybe we could, they'll stop losing money at some point, and they're confident that that's the case. These businesses, and they're just trying to take over as much as possible. My company, New Age, is doing something different, which is we're like making money and we'll go public after we're making a ton of money. So when we're making $20 million a year, we'll probably go public for like 50 times 20 million, which will be $1 billion. Then we'll take that valuation, then we'll take, then we'll take $100 million from that, and then start growing the operation that's profitable into 40 million, 60 million, whatever. But either way, I think that the problem with the MJ ETF is it's full of a lot of companies that went public way too soon, raised too much money, and are all pursuing this strategy of just buy, and push for whatever. But that still doesn't mean it's going to be a bad overall payoff. So it's very cheap right now. It's a great thing to get into. I don't think we're losing money on it, but I'm just not happy about what we're making so far. Oh no, we are. We're down $80,000. I'm sorry, we're down $8,000. We weren't down, but now we're down $8,000. So that's come down quite a bit, and it's a great time to enter it though. It's an excellent thing to enter. It'll probably support a 50-day moving average and start coming back up, because not everybody's having bad earnings reports, but a couple of big ones are, and that's giving us a rocky ride. Over time, though, this thing's going to be huge. Because some of these companies, many of these companies are going to justify billions of dollars in valuation. So anyway, so back to the hedging. So TZA, like the hedge here. All these hedges I like, obviously. I mean, the SQQ, we've got a hedge also. Here, we've got 400 long $8 calls. We have 200 short in the same time frame, $12 calls. So we're only looking to go to 12. And we have 100 uncovered. And then we've got these 25 calls. These are silly because they're never going to get hit. So we're not worried about those. And you can see we're up about 28 minus 5. We're up about $23,000 at the moment on this. So we can easily, this can easily pop to like quite a large level if the NASDAQ does ever sink. Oh, damn it, keep forgetting to look. If the NASDAQ ever sinks, damn it. And it's not sinking at all. I just think when I have these future plays up, I get distracted and I forget to look at them. All right, so up 15.50. That's when I said I get out. I'm going to take the loss. 15.50. And 25.7 is coming up, and 28.57 is just shy of 28.60. It's not looking good though. And what's the dollar doing? Forget gold. What's the dollar doing? DX. The dollar's hanging out. Don't see any news driving this. Not that we need, I mean, obviously not that we need news to have hit these numbers these days. I really want to be short on the NASDAQ right now too. It's a shame. I really hate to have to stop out of this position, but I might have to. Very sad. So they're not all winners. Oh, look, natural gas is losing $30 too, so we're not doing too good today. Thank God for coffee. But let's see, where's our break even now? Our break even is 75.12. That's not unrealistic. I gotta go with my gut on this one and hang on to it. I mean, look at the way this market's been going, right? I mean, it's let's do so look at the NASDAQ here. So we came up to here. That's not even the, sorry, IXIC. No, that goes back to the composite. How do we get 100 NDX? There we go. Okay. So see here, here's a line over here roughly, 75, well, 75.25 is the line I care about. So that's up here. And so I'm betting that this is going to become resistance and we are going to come back down a bit. And as you can see, it's a little erratic, but we had a nice gap down here. I'm hoping for something like that, which will pay a lot. This one went from 75 to 80. Well, forget that. I mean, that'd be crazy. 7580 to 7400 is 180 points on the NASDAQ. $20 a point. That'd be $3,600. So, you know, and that's the thing. I think that the possibility of getting a gap down, at least a 25-point drop like that, that'll pay $500 a contract. I think that's a lot more likely than a 25-point pop up from here. I just don't see that we have that kind of strength in the market right now. But everybody's very excited about the Dow being up 100 points, and especially coming back from down 200 earlier today. So that's probably driving things. And we'll see what happens. So, anybody got any questions? Let's see. Nope, nobody. Come on, guys. Okay, well, I'm going to wrap this up soon if there's no questions, because I don't really have a lot to talk about today as far as that goes. I'm sorry about the NASDAQ trade not working at the moment. Gasoline, and not that excited about that. Natural gas we picked up. Dollar, silver too high. Apple, obviously I like them down here. The dollar, oh, we had a dollar. So what was this, gold? So the dollar is kind of neutral. 97 is basically too low on the dollar, and 98 is too high apparently. So we're kind of stuck in this range of the dollar, but eventually it's going to break up higher. You know, depending on how the Brexit stuff goes and everything else. But for now, we'll see where it ends up. Gasoline, hopefully that'll pull back a bit and we'll get another chance to enter. We already got out of that today. And that's it. There's nothing else going on here, and there's not much going on the indexes. But what we're watching mostly is those lines. So let's take a look at that. You know, these lines for the bounces over here, and let's see how we're doing. See if we made any improvements. Oh, that's not helping. There we go. All right. So on the Dow, 25.7 is going to be the strong bounce line, and we think now it's very likely we're going to get rejected at the strong bounce line. So that's again why I don't want to bug out on my NASDAQs yet. 25.7 is the strong bounce line there. 28.60 is the 5% line here. A lot of key points we're hitting that could be rejected. 75.40 on the NASDAQ is the weak bounce line. All right, but I'm surprised we're here at all. And 15.50 is the 5% line. So as I said before, we're over 15.50 here and over 28.60 here. Then I want to take this bet off. But if they're under it, I still think we're going to get rejected. And Dow also 25.7. So all three of these are at their rejection points, not the NASDAQ. The NASDAQ popped over theirs, but the other three indexes are at their potential rejection points. So this is the time you want to watch them very, very closely to see if they confirm the NASDAQ's move higher. And being 0.1 over doesn't count as confirming it. So are they going to confirm the NASDAQ's move up, or are they going to all start heading back down, and then the NASDAQ will turn down and follow, in which case I'll finally be happy about my trade. All right, but if not, I'm going to have to take my loss. If he breaks over, if any one of them breaks over, I should really take my loss. So I'm watching this very closely. I really expect these guys to be rejected here because there's no news. There's nothing driving this game. So effectively, the index is moving up for no reason. The NASDAQ is up 1.5%. Apple is only up 1.5%. So it's basically following Apple. And there's no news on Apple either. There's just no reason these things should just be going up for nothing. So we will see what happens. We'll have to keep an eye on it later. I'll let you guys know next week. We'll talk about it. But other than that, I think it's pretty much done. I think we've covered all the topics I wanted to cover for today. All right, any other questions? Oh, that's right, I gotta get back to work. So what is a good line to jump out of some long YNs? All right, wait, let me get this straight. Oh, now all of a sudden you guys got tons of questions. Come on. All right, let's see. What are your thoughts on ALB? We like ALB in general. We have some, I think, in the long-term portfolio. Oh, they're not the long-term portfolio. I remember getting them. Oh yeah, here we go. We have a pretty aggressive position on these guys, and they're killing us. I'm going to have to, again, it's another one I'm going to have to read up and figure out why they have been having such a bad time all of a sudden. But yeah, look, they got really crushed in the last month or so, and it really hit us hard in that portfolio. So, you know, and you can't blame the recent sell-off for all this. I mean, this thing's been deteriorating all the way back down. Now, we think it's a great bargain down here, and hopefully it'll hold that line, but we're going to have to revisit our premise before we decide. So take a look. When I do the long-term portfolio review, I will be writing my thoughts on what's going on there. Is Intel a good value here? Intel also is in a cycle, and their cycle is that their new chips are just now coming out. So as a cyclical stock, yeah, definitely, I would probably go in here. Do we have Intel? I don't. We have so many positions. I don't know what we even have. Damn, I wish we would have liquidated. All we have is the short puts on Intel, and they're at the same price they were basically. We sold the 2021 40 puts, but now would be probably a good time to start getting in and picking up a bull call spread on Intel. So I might add that too. Even though I cash everything out, I might add that to the long-term portfolio. I'm getting so tired. This week, great time to just cash out because I don't want to do the reviews. Tempting. Now, what's a good line to jump out of some long YM? So if you're in the long Dow calls, that goes back to here. These are our lines. So we're over 25.2. We're over 25.40. The next place that we're going to hit resistance is 25.7. So we know that. We know that's where we're going to hit some resistance. So as you get up to 25.7, you've got to be serious. You got to have your finger on the trigger to say, okay, if we're rejected here, maybe you want to get out and wait till you cross back over to get in again. All right. And then once you get over that, you just calculate the next 5% up. But a strong bounce, if you clear 25.7, that just becomes your floor and you set a new stop there. Would you adjust the LB trade with the LB at 22.50 now? Where is our LB trade? Control F, LB, not ALB. We just did that. So at 22.50, we have the $20 calls. We sold the $35 calls. I think I might be inclined to buy these back, but I'm not inclined to change anything else. I still think it's going to hit their targets eventually. I think LB is just a turnaround story and people are just too impatient. Now, the $35 put short calls are so far out of the money that it's almost like a waste of money to buy them back unless we think we want to sell something else later. So I have to consider that. But do I want to change it? No, we have the $20 call, so we're in the money. And as long as we get back to like 26 or so, we're going to be fine. So I don't think I want to really make a big adjustment, but I might want to buy back those 35s, but I don't think we're going any lower. And the 35s are 2021, and they're only about 28. So that means over the next 20 months, we're going to collect about a nickel a month on these short calls. So can we do better than a nickel a month with almost anything? Of course we can. In fact, if you think about it, since those are only going to pay $1.28 over 20 months, if you were to just do some work and pick up LB, well, May is 2 days. Let's say where are they now? 22. If we sold these 27.50 calls for 15 cents, that would be 3 times more money than we're getting paid for the 2021 short calls. And 27.50 is quite a bit out of the money. We'd be thrilled if it got to 27.50, so we don't even care if we get hit. Obviously, I don't like selling something that close. I like to get more money than that. But the point being, it's not going to be hard to make more money than that. Since I can make 3 times more money than that with a single sale on a monthly basis, then I could sell 1/3 of that amount and make the same money as I would have made. You know, see what I mean? So there's so many ways to make up that money that it's not worth keeping it open. So you know, just and the main point is, of course, the idea is that if we get a pop and we go back to $26, then I'm going to want to sell $27.50 or $30 calls in 2021 again, but for a much higher price. But if I have the 35 call short, I'm going to be restricted. You know, not that I can't do it, but I feel hampered because it's just, you know, you don't want to have that hanging over your head as a naked short call, because once I cap the other ones, those become naked shorts. All right, so hopefully you understand what I mean. So it's, in other words, it just makes us a little bit more flexible to buy them back. And since we can sell shorter terms for so much more money, then it becomes worth it. All righty, so that's going to be wrapping it up for today. Hopefully we all learned something, and I learned not to short the NASDAQ. So that's my lesson for today. And stay still here though, still under 50 and still under 60. I'm just so annoyed though. It's not going my way at all. All right. Anyway, so like I said, I learned not to short the NASDAQ, and hopefully by next week this thing will fix itself. All right. So have a good day, everybody. We'll do it again next week. Thanks. That's not it.